My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today we got an old friend back again, Aaron Fragnito. Aaron is a very accomplished real estate entrepreneur. He's into multifamily properties in New Jersey. He's also a podcast host with the most, and I've had the pleasure of being interviewed on Aaron's show as well. So Aaron, great to have you on mine. Thanks for coming back, buddy.
Thanks a lot, Dave. Glad to be here, my friends.
All right, very good. So give everybody a little snapshot of what does real estate investing look like for Aaron Fragnito in 2025? What kind of properties and what market, and what is the current portfolio?
Well, Dave, I'm seeing great deals out there. As Warren Buffett, I think Warren Buffett once said this, at least people say that he said this, right? When others are scared, be greedy. When others are greedy, be scared. Well, I'll tell you, it's people are scared right now, right? The stock market's going up and down, a lot of volatility. Interest rates have been high for 2 years. I'm seeing a lot of real estate on sale for great prices compared to what it was at 2, 3, 4 years ago.
Yeah.
And a lot of motivated sellers. Rent has stayed very strong in the New Jersey market here where we invest primarily. And so it's a bit of a perfect storm. Interest rates are high, so prices have come down. Rents have grown and continue to grow. Yes, the cost of money is a little bit more, but it's actually come down a good amount. Last deal I bought, I locked in a 5.4 interest rate. I'm looking at locking in 2 deals right now, and I'm around a 5.3 interest rate on that with a 1 point buy down for agency debt. So, right now it's a perfect time to buy real estate. And when other people are nervous about the market and running around, and that's a great time to focus on getting great deals. So
what kind of deals are you focused on, and why in New Jersey?
So right now, what we are seeing a lot of are Class A real estate, okay? Buildings that were built 2 to 4 years ago, high demand locations, pretty much brand new real estate, where the landlord is also the builder and the developer. They are not in the business of really holding on to these assets. Their plan was to build them and sell them, right? In New Jersey,
they built them, and the plan was to sell them for a huge profit when the go-go days were at the peak. Yeah,
right. And they probably underwrote it in 2018 and said, oh, well, properties are selling at 4 caps. We're going to laugh all the way to the bank. By the time they were done, properties are selling at 6 caps. And they're saying, ooh, holy mackerel. And by the way, my interest rate, maybe I have a floating rate, doubled during that time. So they're motivated. They're motivated to sell. Maybe they refinanced, got some of their money back, but they still probably refinanced in like a 6% rate or something like that. So they're also not really in the business of being landlords and property managers.
No, they're developers, right?
Yeah, they tend to underlease the units, kind of give them away for a better price to just get the building leased up quickly. You build this thing, you're in a mad dash to get it all leased up, so you're giving away contingent, all these benefits that cutting your leasing price, and then what you end up with is a building that's under leased. I'm buying a 48 unit right now with rents easy 10% below market value, but it's a beautiful asset, hardly needs anything, brand new build, great location. Buying another one, the rent's 23% below market value. Wow. 14% vacancy. This is a beautiful Class A asset in downtown Newark, great location that's just mismanaged and under leased. We can buy these buildings at 6 caps, 5.5 to 6 caps, where these previously 2 years ago, I'd be lucky to get this at a 4.5 cap. That's a huge price difference. So we're able to snag these at great prices.
So maybe translate for people that don't understand the differences between the cap rates there, like dollars and cents. Give us a before and after example of how much that property might have been worth and what you were able to get it for.
Sure. Well, so basically to the real estate, commercial real estate 101, you got to understand your cap rates. What that means is it's a quick formula to determine what a property is worth based on its net operating income. So in layman's terms, let's do an example here. Okay. Let's say the net operating income of a property, right? The gross revenue minus the expenses, not including debt service, is $1 million a year. All right, let's just say $1 million.
Okay.
Now, let's say we're buying this in 2022, okay, and or 2021, okay, and cap rates are at 4%, meaning the cap rates are low. All right, and the properties are going for a lot more money. You're getting less real estate for your dollar. Prices are high, cap rates are low. This is a hot market, okay? Think 2018 to like 2022, right? Interest rates are low.
Yep.
Everyone's running out and buying real estate like there's no tomorrow, okay? So let's say it's going for a cap rate of 4%. So I'm going to take $1 million annual NOI. I'm going to divide that by 0.04. That's going to give me a value of $25 million, okay? Now, so that's what this property would be worth
2022-ish.
2022-ish, right? In a
Okay.
hot market, okay?
25 mil. I got it.
25 mil. Okay, now fast forward to current day. Interest rates are high. Prices have gone down. The market is in a slump, okay? Cap rates have increased. So let's take that 4 cap and let's move it to a 6 cap. Now this building's worth $16.6 million,
Wow.
okay? So you just bought this building for a discount of $8.5 million, okay? Because the market is in a slump. All right. Now, you're going to want to underwrite this. So when you go to sell it, you're also selling into a six cap market. Okay. You're going to
Yeah.
increase the rents, lower the vacancy, drive up the revenue of the building, sell it over a 3 to 5 year period, reposition the asset and exit. Okay. However, if you run those calculations and you sell into a market where cap rates, forget the 4, call it a 5, man,
Yeah.
you're going to be laughing all the way to the bank, you know?
Well,
So,
plus it sounds like you're like, I'm just thinking about the examples you shared. So you bought a 48 unit and it's like, I can't remember which was that the one that was like 25% under market rate
that's a 63
rentals?
unit where it's
63
quite
unit. Okay.
distressed. Yeah. Mhm.
So you're buying it at, a discount compared to a few years ago. Plus you've got the opportunity to turn around some of those units, get them up to full market rental,
That's
which
right.
increases your net operating income. And that's
Mhm.
doesn't really matter. Well, irregardless of cap rates, you're going to be bringing in massive value just by bringing the rents up there, and
Correct.
then
Correct.
get the
Never.
cap rates. Yeah,
Yeah.
yeah,
Never underwrite a deal assuming cap rates are going to compress. Then
yeah.
you're
It's a
just playing
bonus.
a fool's game. Yeah.
Exactly.
Now you can hope and pray cap rates compress and you time the market perfectly and you're more lucky than smart. Yeah, that happens, right?
That's what a
Um,
lot of people were counting on a few years ago. I think, Eric.
yeah, absolutely,
Yeah.
absolutely. Luckily, I was not one of those guys, so we're in a good spot. But basically, you want to buy properties of value add, right? Rents
Mhm.
below market value, maybe high levels of vacancy, operating expenses that are higher than they need to be, or should be, and room to improve the units. And quite often, we're buying Class C buildings with outdated units, old apartments, trash in the backyard, trash in the basement, no amenities. And we just bought a building in Passaic, New Jersey, a 42 unit. We're putting $1.1 million into that.
Mm.
It's classic mismanaged Class C building, bunch of trash in the basement. We're cleaning it out, putting in storage units and laundry, a bunch of trash in the backyard. We're putting in a barbecue area and a jungle gym for the kids, and just
Nice.
cleaning it all out, making it a nice building, an attractive place to live, renovating the units when tenants move out, putting a lot of CapEx into the building, a ton of heavy lifting throughout the asset. And that's normally how we're creating value for these assets. That's what we've been doing for the last decade for our
So,
investors.
so you're focused on New Jersey. Why do you like that market when other people are kind of scared of that market?
So what we see is if you buy within an hour of New York City here on the Jersey side, you have a line out the door for your rental units. There
Mhm.
is a shortage of housing here. There's an insatiable demand to live in northern New Jersey. We consistently rank in one of the best places to live. We have some of the best schools, best education, highest paying jobs, safest neighborhoods. If you want to go to the beach, Dave, it's an hour drive. You want to go skiing in the mountains, it's an hour drive. We have the most parks, I think, of any state or something like that. Like we are called the Garden State. It's a beautiful suburban area that a lot of people live in here in Jersey, and we're also one of the most densely populated states. So there's a lot of people who need a place to live. We are the third best rental market this year. A lot of times we rank in the number one rental market in the entire country. There's a shortage of housing here. And guess what? It's hard to build housing here, right?
Yeah.
We're in a blue state. So that means the bureaucrats get in your way and slow down the housing developments. That means that our property values will remain strong because the bureaucrats can't get out of their own way, and that slows down supply to the market, and that keeps our prices high. So that's an insurance
Mm.
policy that will always have stupid bureaucrats running the state, and that means that our prices will always be ridiculously strong and high, and that's great for landlords.
Yeah. No, that makes a lot of sense. Very, very cool. So where do you see things going for you and your companies over the next 12 months or so?
Over the next 12 months, right now we're working on acquiring these two Class A assets, a 63 unit mixed use building, a 48 unit mixed use building. We have some exits coming up. We'll be refinancing and selling about four properties over the next 2 years. We are working with institutional level investors. We're working with family offices. We plan on raising about $20 million of equity this year, about $15 to $20 million of equity, and acquiring about $40 million of assets this year. We plan on then raising about $25 to $30 million next year and acquiring about $50 million in assets. By In 3 years from now, we plan to raise about $50 million in equity and acquire about $100 million in assets, and then start to exit additional assets into 28 and 29 is our 5 year plan here at PCG.
Oh, that is exciting stuff. So Aaron, what's been your takeaway or your learning transitioning from dealing with just normal accredited investors and now moving up into family offices and dealing with those guys?
Sure. So we love our accredited investors and our retail investors. They helped us get to where we are today. We've been around for
Mhm.
over 10 years, done about 300 transactions here in New Jersey. We have over 100 private investors that invest with us. Some people have $30,000 with us, self-directed from their IRA. Other people have well over $1 million with us. C-suite executives, white collar, blue collar workers, just hardworking Americans that want to invest wisely in real estate and create cash flow and big liquidity events and tax benefits for themselves and their families and generational wealth. So we continue to invite them into our projects. We do also love working with family offices. Obviously, when you're raising capital and trying to buy larger and larger buildings, it helps to have larger check writers. And a
Mhm.
lot of our family offices are very loyal to us. They understand we run a good shop here. We have a nice infrastructure with an in-house property management company and a good track record of sourcing great discounted off-market deals. And family offices like under the radar companies like ours. We're not some big REIT. We're not a publicly traded REIT. We are kind of a more of a niche shop here where you can get in on great deals for great prices and consistently make strong revenues for your investment. And institutional groups too, fund to funds like us, because we are boots on the ground. We're the real deal. We focus on one market. We've been doing this a long time, and we get great deals that no one else knows about. So we're a big value to, let's say you're a big institutional group and you have a pension fund behind you. You don't really ever see the deals that we're going to see. Or you're a family office, and you're working with a few hundred million in assets. Again, you're not really boots on the ground like we are. We can bring those deals. We can underwrite hundreds of deals to cherry pick the very best one, bring those well-vetted opportunities to our investors, and allow those family offices and institutional groups to get in on deals they would have never had the opportunity to do so with. And also invite our accredited investors along on those opportunities as well. But now they know that they have the backing of savvy money, high net worth, families and institutional groups in on the deals as well. And if they're writing a check for 5, 10, or $15 million, then you better bet it's a good deal. And you might feel more comfortable writing your check for 50 or 100,000.
So what are some of the ways that you're sourcing and finding these deals these days, Aaron?
Well, Dave, if I told you that, I have to kill you. So,
No, you
that's
wouldn't. Just give us the big broad strokes.
no, it's all good. We get our deals primarily from brokers, actually. Okay. It depends on the deal, right? So, like, we also have a small debt fund that investors invest in. They get a nice quarterly interest payment. And the debt fund, we're buying small fixer-uppers, we're buying small multis, we're buying land. We just had a meeting with a developer. We're working on a 3 townhouse development in Weehawken, New Jersey. So, for stuff like that, we get it from wholesalers. We get it
Hmm.
from other landlords, other developers. Again, off-market deals, like nothing's like sitting on the internet, but that's we source generally from wholesalers. Now, when we get into the bigger stuff, buying the $20 million assets, You really don't get that from wholesalers. You get
Yeah.
that from brokers, CBRE, Marcus and Millichap, Berkadia, the big guys, right? Cushman and Wakefield. We have relationships with them and small like mom and pop commercial brokers as well that we know that kind of work well for buyers. And when they get a deal, they have a list of buyers they go to. Okay.
Right.
So in
And you
commercial,
guys are the Jersey guys. They
yeah,
know that if it fits your box. Yeah.
we're the Jersey guys, the listing agent is your buyer's agent, right? So they get the full commission. They bring you the deal, right? It's not like residential real estate when you're shopping for a house, you have a buyer's agent and a listing agent. No, it's like, here's the deal, guys. The listing agent's direct to the seller. Here's the price the seller wants. We do our underwriting. We get back to them quickly. We make a strong offer. They know we're good for our word and we are professional closers. So we're not going to nickel and dime them. We can get the debt lined up quickly in the equity. And ideally, we get the property for a decent price before anyone else knows about it. Um,
Yeah.
and that's
No,
the best
that's
way to buy real estate for a good price, to be the only bidder in the room or one of few.
so for some of the folks that are watching this that are kind of getting into the space and they don't know how best to deal with brokers, any tips, tricks, and suggestions there?
Well, brokers are just like any other business relationship. Take them
Mhm.
out for breakfast or a cup of coffee or lunch. Get to know them, explain what you're trying to do with your model. Even if you don't have any experience in real estate, explain to them, kind of your business model, your financial backing. Have your ducks in a row. Don't like
Mhm.
be like, oh, I'll figure out how to get the money, and maybe I'll, what's the cap rate? No, you got to like know your industry, know your stuff, have your dream team in place and then the brokers are still going to be like, maybe close on a few deals and then come back to me. A lot of people preach start with like 100 units. I never agreed with that. I mean, in reality, you go to a broker, you try and buy a 100 unit, you tell them it's like the first deal you're ever buying, and you're going to like figure out how to raise the money. It's
Yeah,
like not going to happen. He's not going to send you the deal.
exactly.
He's got so many other groups in place, and he's a good broker. He's just going to bring it to and then you're stuck maybe buying something on LoopNet or something. Even so, like it's probably some, not a great deal if it's sitting on the internet. So in this market, you got to start small. I mean, a lot of people start, the first building I ever bought was a single family fix and flip. Then I bought a 5 unit, then I bought a 6 unit. We've still fixed and flip properties. We still buy small multis, but then I bought a 25 unit. And then I bought a 20 unit and a 30 unit and then a 40 unit and you kind of work your way up and you get your
Yeah,
closings done. You put some checks in the pockets of these brokers and lenders as well. They're going to want to see some equity. They're going to want to see a track record and investors too, the people writing the equity checks. It's a lot easier to kind of say, hey, I'm going to raise $400,000 and buy this six family. And do you want to come in with 100, rather than, hey, I'm going to raise $4 million and buy this, and then it's like, well, I'm the first 100 in the pot, how much do you have? Come back to me
yeah,
when you have 3.9 million raised, for your four.
exactly.
Um,
Yeah, good advice because so many people just want to chase after the huge deals too fast. It makes
mhm.
sense. You gotta get that experience behind you, or join a team that already has that experience and be a co-GP on something like that,
Well,
where you got a
that's
much
it.
smaller role in the whole deal.
That's exactly what I was going to say, Dave, is
Yeah,
that if you want to get in on big deals, which bigger is better in real estate, you make more cash flow, you have more leverage, your closing costs on a percentage basis are less and operating costs are less, so bigger is better in real estate. There's no doubt about it. Efficiencies of scale. Then team up with a group like ours or a similar group that has a great track record, has the pieces in place, has a great deal on the board, and be a fund of funds, and go out and raise $500,000 from your friends and family, like how we all started. Pool the capital together, work with a company like TribeVest or Avest or something like that, and get them behind you so they kind of help you create this fund of funds and work with a group that's going to guide you through the process, like we do with some fund managers and bring 500,000 or $1 million into a deal. Charge a fee to your investors or whatever. You charge a fee to there's lots of ways to split it up. You can double dip, so that's the way you do it. That's how you get started in this business. And when you see, online or something, a guy that's like, yeah, I've bought 1,000 units in, 6 months. Normally it's actually like, well, they raised 300 grand for this deal. They raised 500 grand for this deal. And they got in
Or
with a group
150
like
grand
ours.
for this deal. And yeah,
Yeah,
yeah.
yeah, yeah, yeah.
So there's
And they
sliver
got
of
in with a group
equity.
like ours that's buying 100 unit, and like,
Yeah.
yeah, they own like a small percentage of it. But yeah, I mean, listen, at the end of the day, they own 100 unit, right? So they can say
Yeah.
that. So, but that's a fund to fund manager, and that's a great place to start.
Yeah. Good advice. Aaron, if I'm sure people are going to want to connect with you, where's the best place for them to go?
So our website is peoplescapitalgroup.com. That's where they can learn all about what we do here and how to qualify to invest with us as well. We have ebooks, we have 7 red flags, we have different calculators on our website. We have over 200 YouTube videos and educational videos and webinars and podcasts. I have a podcast called the Passive Cash Flow Podcast. Passive Cash Flow Podcast. That's on Spotify, YouTube, iTunes, all the major platforms. And I also do a webinar or a masterclass every single month about different topics in the space. Our last one was how tariffs affect real estate. And before that, it was your guide to New Jersey real estate investing. We are New Jersey market experts, and a lot of people appreciate us for that value. But at peoplescapitalgroup.com, we don't sell education or anything like that, just a bunch of free content for everyone to enjoy.
Thanks so much for being on the show. It's been a lot of fun, Aaron.
Thank you, Dave. Have a good day, my friend. See you
All
soon.
right, everybody. Take care. We'll see you on the next episode. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.